Good evening, everybody. Namaste. Thank you all for joining. If you don't know, I am the president of India Association of Television, and my name is Arun Pondicherry. Thank you all for joining. This is our first virtual event, and Mr. Jayam Mariappan will be, giving you the slideshow, and he'll be talking. So I would like to introduce him before he starts. So Jayam Mariappan Mari has decades of experience in technology, personal finance, and investment areas, and he founded Samatwa Wealth Management LLC, registered investment fiduciary advisor, and provides independent fiduciary financial planning and investment advice to individuals, families, and small businesses. Services include asset management, retirement planning, financial planning, college savings, plan for kids, life insurance selection, mortgage refinancing, health, living will and trust help. Transferring assets from India to. So he graduated MBA Finance from Johns Hopkins University and also holds.
Okay, Arun, 1 second. Let me probably mute everyone, then you can unmute and talk. Okay. Yeah, Arun, please go ahead and unmute yourself, then we will continue.
Okay, there you go. Yeah. Okay. So he graduated MBA Finance from Johns Hopkins University and also holds Chartered Financial Analyst CFA designation. He worked as Systems Development Director in Xerox Corporation and a project consultant before founding Samatwa. He had finished his undergrad and grade degrees from CIT and PSG colleges from Coimbatore. He is a leading mentor in startup Ignite DC and part of board of advisors for 5 startups in the Washington area. So thank you, Jayam, for agreeing to give the presentation. So please go ahead and you can start.
Thank you, Arun. And also I would like to thank Rajan for actually helping me to kind of provide this opportunity to present this webinar to the Indian Association of Nebraska and Lincoln members. So in this session, we are going to cover 3 main topics. One is the retirement savings, then how to use the different tools to save taxes while saving, and also invest, and what are the good strategy, funding allocation strategy to enhance the returns. Then we'll have a short Q&A session. So while I'm covering the topic, please go ahead and post your questions in the chat window. Then Mr. Arun will read those questions during the Q&A sessions, and I will provide my feedback. Then the second topic we are going to cover is the college savings for your kids. The college expenses are very high, so I'm going to cover the strategy or whatever I have learned. So we'll talk about that. Then final topic is the repatriation, which is transferring the assets. Let's say you have a land or apartment or house, you want to sell it and move that funds to from India to here. So I'll cover what's the tax rules and the process involved in India and also in US. Okay. So that's our agenda. So with that, I'm going to start with the retirement savings. So before we talk about the retirement saving, there are 3 main things. Please try to implement that as soon as possible. The reason is without these 3 things, whatever the plan you are doing for your retirement will get spoiled, or you may not be able to do it. So the first thing is backup and continuity plan. Document and share all the financial information with your spouse. I know mostly our Indian community, the husbands are handling majority of the finances they are handling. So if you look at the slides I'm sharing with you guys, there are a lot of financial records we have to track, right? Your retirement funds, insurance information, credit card, debit card, expenses. So my recommendation is, actually I'm going to just show you guys one template. So I would recommend in a Excel spreadsheet, you can just document all the records and document whether it's a paper copy, where do you storing, if it's a online, what's the URL and password. So I strongly recommend document all those things. You can password protect it, put it in a secure folder in Google Drive, Dropbox, or even Flash Drive. So whichever it works for you, definitely please do that. Then the second thing is emergency saving. So make sure that at least you have 6 months to 1 year of your expenses in emergency saving. The place you can keep your emergency savings is obviously your checking account, or your high yield savings account, or at a maximum I would recommend put it in a CD, like a 12-month CD. The interest rates are very low, but at least you'll get some return out of it. I wouldn't recommend investing these emergency savings in the stock market. As we all know, the stock market can go up or down. The volatility will always be there. We cannot predict. So I'd strongly recommend keep it in your safer investment, because you never know when you need it. Because we already know what happened during COVID, right? So that's why it's very important, because we don't know, because of job loss, car repair, medical emergencies, or major home repair. Because if you don't have, then what will happen is a lot of them are going to withdraw the funds from their retirement savings, whether it's 401k or IRA. So that's not a good strategy. I'll tell you why. Because a lot of people are withdrawing from their 401k. Let's say if you are going to withdraw $50,000 to meet your emergency expense, so you are not going to get the complete $50,000, because you'll only get after the 10% penalty. Then on top of it, you'll have like 25% income tax rate. So you're going to get only the $32,000. So if you do the math, let's assume if you are not going to withdraw this money and leave it in your 401k, so this $50,000 will grow in the next 30 years into almost more than $250,000, like $280,000 plus. So that's the amount you are going to lose by withdrawing your funds now. So that's why the amounts may be small now, but actually you are going to lose a lot over a longer period. So that's why I strongly recommend, please do not withdraw your retirement funds now, because the retirement savings is for a reason, right? So that's why by having these emergency savings will help you to avoid that. Okay? Then the third thing, at least have term life insurance. Okay, having the proper life insurance coverage is a must for every family. Unfortunately, we are seeing, particularly in our Indian community, people don't have the correct life. Not many people have life insurance at all. And another thing is they don't have the correct level of life insurance. So if time permits, I will cover those at the end. But at least I'll give you some few important things. So calculate the coverage amount you need. So how do you calculate? Make sure that include at least 5 years of your annual expenses, and include your home mortgage loan balance you haven't paid so as of now. Then your car loans, if you have any credit card loans, and let's say if you have 2 kids, I would recommend add $200,000, assuming if your kids are going to in the in-state college, or if they're going to go out of state, then add $350K. So I think if you do the math, it will be definitely will be close to $1 million or more than $1 million. So buy the term life insurance to cover that much money. The other thing is when it comes to term life, the coverage term, whether it's a 10-year, 15-year, or 25-year, or 30-year, the maximum you can get is a 30-year term. But my recommendation is, as long as someone is depending on your income, So you should have that coverage. So I would recommend go for until you retire, and maybe the maximum 30 years. Okay, so to recap quickly, as I said, 3 important things. So have your backup plan. So document everything, share it with your wife so they know what the information. So if something happened, they know where to go and get the information, right? Because the thing is, if you don't have that, and also if you don't make your wife as a spouse as a beneficiary for the bank account and other retirement account, there is no way she'll have that access, right? So that's number 1. And the second thing I said, the emergency saving. At least have 6 months to 1 year of your expenses in your checking account or savings account or in CDs. And the third thing is definitely have your at least the term life insurance to have the enough coverage amount for the enough period depending on your situation. Okay? So with that, we'll move on to the retirement. So let's talk about what will happen if you don't have enough retirement savings. So you're going to keep working, no retirement. You know, I have seen some people, they sell their home to cover their retirement costs. That's not a good idea. Then some people, they borrow through a credit card. That's also not a good idea. And finally, getting support from your kids. You know, that's going to be a very toughest thing because when we retire, our kids probably will be in the very early stage in their career. I think it will be very difficult for them to support even themselves. So I think none of these options are very good options. So I think the good option is to save enough funds for your retirement and invest. Then why it's important? So if you guys look at the life expectancy, the world level, people are living more than 70 plus years, and if you look at the United States level, people are living more than 80 plus years. So if you're retiring at age 60 or 65, so definitely you need enough retirement savings to cover maybe 20 years or 20 years after retirement. Okay? Then move on to the next important topic. A lot of people don't know, okay, how much we need to save for your retirement. So I'll tell you, this is a very general numbers. It depends on the expenses. So let's say after your retirement, if you need $50,000 per year, so that means at least you need $1.5 million when you retire in your retirement savings. But let's say if you need $100,000 per year, obviously then you'll need $3 million. So this is kind of a general advice. So this probably will cover 90% of them. But normally what I do for my clients, so if you want kind of a very specific planning, how much you need and what your expenses is going to be. So what actually I do for my clients is gather how much their savings, then analyze what is going to be their return after their retirement, plus how much they are going to save from now to their retirement. So I kind of calculate and find out how much their projected value at their retirement. Then I gather all their expenses. Then I calculate what's their projected expenses at retirement, as I'll include the inflation impact. Then I do an analysis. So just for analysis, let's say at the time of retirement you have $800,000. Okay? So your expenses, let's say, going to be $57,000. So based on that, you can see inflation adjusted. You are going to withdraw $50,000. Then the next year maybe $58K. Then you can see it is going to run out by the time when you reach almost age 85. Okay. So by age 85, your savings, you are going to have a negative balances. So that means clearly you can see this 800K, it's not sufficient, right? But at the same time, let's say if you have 1.5 million, right? Then for the same $57,000, you can see your portfolio will never run out of money. So you can see even for when you age at 95, you'll still have your decent balance in your portfolio. So you can see two things. So one is you need to have sufficient savings. That's number one. The another number two is your reasonable expenses. Even if you have, let's say, $1.5 million, but let's say if I'm going to plug in $90,000, let's say your expenses are going to be $90,000, so you can see what it does. So again, you will run out of money by the time age 87 or 88. So that's why it's very important is how you manage your expenses. So you have to decide what your expenses, then based on that decide how much savings you need. So that has to go hand in hand. Otherwise, there is a very high probability you'll run out of your money during your retirement. Okay. Okay. Next. So when it comes to finance, so there are 4 slides I'm going to cover. Please keep that in your mind and ingrained in your brain, and I think you'll definitely achieve your long-term goal. So look at this one, the power of positive compounding. So let's say you're having a $1, you just keep it in your mattress, you're not doing anything. Whether it's after 365 days or 365 months, the dollar is going to be $1. Actually, worst case, if you include inflation, actually the dollar value will be definitely less than $1. But let's say if you even invest, if you get a 1% return for 365 days, the value is going to be actually 37 times. Okay, and so if you look at this, works for finance and also kind of works for your our general life too. So if you are learning something every day, some new skills, obviously your compounding of your skills is going to grow like anything, right? And same thing applicable for finance. And also let's look at the negative, power of negative compounding. So this one, let's say if you are losing like 1% kind of every day or month, again, the value of dollar, you can see it will be worth like 2 pennies. So that's why it's very important have some positive growth to meet your long-term objective. Then the next thing is very important thing is power of tax-deferred compounding. So if you look at this chart, you can clearly see even if you save $200 a month and invest in like a 6% return, let's say 50% stocks, 50% in bond for like a balanced portfolio, but investing in like a 401k or IRA, which is a tax-deferred vehicle, so you'll kind of avoid the tax rate now. So you can clearly see the benefit of the tax deferred. So without the taxes in 35 years, that even the small amounts of investments in a month, it grow into easily $300,000, $400,000. Okay. So, and also the difference between tax versus taxable, you can clearly see $100,000 difference. And also in the chart, you can clearly see the power of compounding will work better when you have a long time horizon. So when you have a 20-year, 30-year, 40-year, you can clearly see the compounding works the best. So that means what? That means try to save as much as you can when you're younger. Okay, whether you're in 20s or 30s, 40s, it doesn't matter. Start now. Okay? Don't wait until later, because the power of compounding will work better when you have a longer time horizon. And also, as you can see, even if it's a small amount, it does the magic. So it doesn't matter you have to save $10,000 or $20,000. You can, even by saving small amount of money, actually will help you to meet your long-term savings. And the next concept is a very, very important concept, is follow long-term investing strategy. So if you look at this chart, this is a Dow Jones Index Fund over 100 years. So you can see the market always goes up and down. So if you look at from 1929, the Great Depression, like 70% down. Then World War II, 1917 inflation, then dot-com bubble in 2000, then 2008 housing crisis, and even recently we all know the COVID, right? Every time the market was down like 50%, 35%, even 70%. But overall, if you look at, so the index gone from 2,000 to more than 20,000. Now I think it's at 26,000 or so. So if you do the average, it's easily 9 to 10% average return per year, right? So that means what? So that means take a long-term view. Don't try to time the market. It's very, very difficult to do time the market. And don't try to time the market, and also don't be emotional. Okay. So when we get emotional, what people tend to do is they withdraw the money after the market fall almost 50%. Then they wait for a few years or a few months after they come back. So try to timing. So they will kind of lose the money on both sides. So that's not a good strategy. Because anyway, these are the retirement funds. You are not going to withdraw until your retirement. So I strongly recommend, so these 4 ideas, keep it in your mind. So understand the power of compounding and start saving earlier, even if it's a small amount. Start saving, and also the main thing is invest your money and take a long-term view. So don't worry about this short-term market fluctuation. And a lot of people are asking, okay, now the presidential election is coming. What's going to happen? Nobody can predict that, right? The market can go up or down, but as a long-term investor, I think I would say you don't have to worry about that. In fact, if the market goes down, I would recommend even invest more. So that way, when it recovers, actually you will get even better returns. Okay. Then the next thing is how to increase the probability of saving. I know why not many people actually not saving much, because they don't automate their savings. So my recommendation is part of your paycheck, increase your contribution, at least like a 15% of your paycheck, so that it will automatically happen. Because if you are going to do that, definitely it's not going to happen. Okay. Then I do have a few slides to talk about. One option is reduce your monthly expenses. So I would recommend track all your expenses and see what are the different ways you can reduce your expenses so that you can direct those expenses into saving. So that's one idea. Then the other thing is you can also look into income stream options. Okay, other than your full-time salary, okay, what are the other ways you can increase your savings, right, or your income? Either you can invest in the CDs or bonds, or even dividend stocks or dividend mutual funds, or maybe invest in the rental property, produce some rental income. So like that, there are a lot of other options. You can think about it, look into it, so that you can produce some additional income. Okay. So let's quickly talk about, so what are the tools that are available. So in United States, okay, unfortunately, most of our guys, we work in our W-2, right? So when you work on a W-2, we only have very few tools available to save our taxes. So the first thing is 401k. So most of the employer offers is 401k plan, and you can save up to $19,500 per year. Okay, this is besides your employer contribution. I know that your employer probably contribute maybe 3% matching or 6% matching. So that's a free money. So definitely match with what your employer matching. That's number one. Then the number two is I would recommend try to maximize to up to $19,500. So that's going to save easily. Let's say if your income is around 100K, you can easily save another, at least $5,000 in IRS taxes. Because I'm seeing people are paying $20,000, $25,000 to IRS. I would strongly advise consider the strategy. At least you can divert that funds for your kids' education or for other purposes. Okay, and your age is above 50, you can actually do a catch up and save additional $6,500 per year on top of the $19,500. Then let's say if your employer doesn't offer 401k, then I would recommend you can also consider the traditional IRA and Roth IRA. So you can save $6,000 per year, and if you're above 50, you can add another $1,000. But for the Roth IRA, there is an income limitation is there. So your gross income has to be less than $139,000 for single, and for if you're married, then it has to be less than $203K. So the main difference between the traditional IRA and Roth IRA is the traditional IRA is a pre-tax. You'll get the tax benefit now, but the Roth IRA is after tax. But the good thing is you don't have to pay any taxes for your life. So the way you have to select the traditional IRA versus Roth, let's say if you're expecting to pay more taxes now, your tax rate is going to be higher now, then I would recommend go with the traditional IRA. But if you're expecting your tax rate is going to be higher after your retirement, then I recommend go for your Roth IRA. Okay. Then the third option also I would recommend to consider is the HSA, health savings account. So if you have a high deductible account, then you will be eligible to participate in the HSA plan through your employer or even outside, and you can save $3,000 for single and $7,900 for married, and it is pre-tax money. So I would strongly recommend try all these three tools to try to minimize your tax liability. So these are applicable for personal tax saving, and when it comes to LLC, let's say if you are working as an IT consultant and you are getting paid as a 1099, corp to corp, S corp, or small business, I will recommend consider the other option. So you can go with SEP IRA, solo 401k, even defined benefit plan. Because what it does is these will allow to contribute even more. Like SEP IRA, you can contribute up to $57,000. So you can save a lot of money on taxes. Same thing, the self-employed 401k, again, same thing. You can do both employee and employer contribution up to $57,000 per year. And the defined benefit plan, let's say if you are the only owner, and a lot of lawyers, attorneys, they use this because you can contribute up to even $200,000 to this plan and save a lot of money from the taxes. Okay, so for this business side or tax consulting, how to save more taxes, you can reach out to me. That's something I would strongly recommend or take advantage of it. Okay. And the next thing is allocation. So let's say now you started saving to your retirement funds. You have maybe 100,000 or 200,000. So how to save and how to invest that money, right? Which is a very, very important thing. So let's say if you have a 401k. So typically your employer will provide like maybe 20, 30 different mutual funds, whether it's small cap, mid cap, large cap, value fund or a growth fund or real estate or bond, long term, short term, target date fund, right? There are lots and lots of options available. So how do you select which option is good, right? So for that, you have to understand what kind of return you're going to get. So if you are allocating to short-term bond funds, the return is anywhere from 1 to 2% per year. And if you're investing in the long-term bond, it could be 3 to 4% per year. And if you're investing in the stock mutual fund, it could be 6 to 8% per year. And if it's a real estate, again, probably 8 to 10%, but depends on the interest rate, right? So understand what kind of category of funds you are investing. Then you have to download the prospectus for each and every fund and analyze the expense ratio, what I call it the management fees they charge. Each of these funds, when you allocate, they charge the fees. Actually, if you read through your 401k statement carefully, you can kind of see how much fees they're charging. So compare the fees with their the return, how much you are getting. Then look at their long-term performance, like a 10-year, 15-year, how they are doing, how their long-term performance. Then check the fund's turnover, how fast they are buying and selling, because that will decide the fees and also the performance, right? So the one important thing I'll quickly show is the fees impact, okay? So that's why when you allocate the funds, So look at the fees impact. So let's say you get average 6% return, okay, and average the fees these funds are deducting, let's say 1%. So look at this analysis. For 30 years, you are saving $90,000, okay, and so this is the value of your funds at the retirement. It's let's say $100,000 at the retirement after 30 years. But the fees impact, because of the fees impact, actually you'll have only 78. So if you do the math, so after the 30 years, so you can see, let's say actually you saved almost $70,000. So without the fees, your portfolio should have $1.5 million with a 6% return. But because of that fees, it's actually you will only have 1.2 million. So that means the amount that lost through the management fees is almost $250,000. So you can clearly see as a long-term investor in these retirement funds what it does to your savings. So that's why I keep insisting. So you have to focus very carefully on these management fees, because for a year or two you won't see that impact much, but as your portfolio is going to grow and get into larger, so the impact is going to be huge, and you are going to lose a lot into the management fees to whatever the funds in your 401k. So that's very important point. Okay? Then finally, the very important thing is when you are getting closer to retirement, let's say you decide I'm going to retire maybe in 5 years. So I would recommend calculate how much you are going to withdraw in the next 5 years after your retirement. Then start allocating that money in a very conservative funds, maybe money market or short-term bond funds. Because the reason is when you are getting closer to retirement, suddenly let's say the market crashed. Even let's say take this the current scenario, right? I'm going to retire, let's say I plan to retire in January 2020, but I put 100% on the stock mutual funds. And I didn't expect the COVID situation, right? Now let's say market down 38%, so I don't have any money to use it to cover my retirement expenses. So that's why it's very important. So when you're getting closer to your retirement, plan ahead at least 5 years before, allocate the 5 years of your expenses into conservative, so that whatever it happens to the market, you don't have to worry about that, because obviously the market will come back. So you will have enough funds to cover your retirement expenses. Okay. So with that, actually, I'm going to stop. I think the next topic is going to be the college savings. So we'll spend maybe like 10 minutes for the Q&A. Arun, so if you see any questions in the chat box, I think we can discuss that. I'm sorry, Arun,
I'll go ahead and read,
sure, yeah, please go ahead, yeah.
So the first question is, hello Mr. Mari, how does whole life insurance that has cash value would help for retirement?
Actually, the whole life, based on my analysis and my recommendation, I wouldn't recommend the whole life for your retirement savings vehicle. Okay. I think if you only want the risk protection, I would recommend go for the term life insurance. I know the whole life offers the cash value, but I think you will be better to save it through this vehicle, because remember the whole life, what are you going to save is actually after tax money, right? So I don't think it's a good strategy to use the whole life. The issue I'm seeing with the whole life, I know they come up with a lot of products, and they unfortunately took a lot of fees. I know there is an indexed whole life IUL. They'll say you'll get the market return, and if the market goes down, then it'll be 0%. But when I did the analysis, even though they say when the market goes from 0%, that's not true. They still take these whatever the 1% or 2% the management fees, and also when they take the market returns, when let's say the market gets 20%, 30%, but these policies they put a cap on it. They'll say only give like at 8%. So the issue with these whole life products, they make it so complex and it's very difficult to understand, and lack of transparency and a lot of hidden fees. So that's why I would recommend the life insurance is for the risk mitigation. I wouldn't recommend as an investment product. Okay, so I would recommend go with either your 401k or IRA, using that so that you get the tax advantage and invest and grow. This is choosing your whole life product.
Thank you. The next question is, do HSA and traditional IRA contributions be deductible besides standard deduction?
Yes. Remember, the HSA is a pre-tax, so it won't be included in your itemized. So that's why it's kind of similar to your 401k and traditional IRA. So it's all a pre-tax. You will get the pre-tax benefit. Yeah.
So the next question is, so when you get a chance, please reflect your thoughts on taxes in retirement. Do you expect taxes to be less with the way the debt is mounting up for this country?
Okay, that's a very good question. Okay, I know it's very difficult to predict what's going to be the tax rate at that time, but I'll tell you this, because when you retire, let's say you have $1.5 million in your portfolio, okay, but you are not going to withdraw all the money on day one, right? So definitely you are going to withdraw only the money you need to cover your retirement living expenses, right? So it could be maybe let's say $50,000. So with that, typically remember the way in United States tax system, it's a progressive tax rate, right? Typically, if you have like less than 50 grand or 60 grand, maybe 10% or 15% tax rate. And once the income is higher, let's say maybe 120K or 200K, then only the tax rate is going to be 20% or 25%. So I would say it's not going to have much tax impact for the retirees, because you are going to withdraw very small amount to cover your retirement life expenses. So you'll be kind of comes under the lower bracket. So your tax liability is going to be actually small.
Okay, thank you. So the next question is, this year I contributed to traditional IRA $6,000, but recently my employer started offering the 401k where I can contribute $19,500 for 2020. What will happen to traditional IRA contribution? Can I move traditional IRA contribution to the Roth?
Okay, good question. So I would recommend the first thing is try to do your $19,500 through your employer, right? Maximize that. Then what's going to happen is your traditional IRA, when you file your taxes, based on your all the other deductions, let's say you may be eligible out of the 6,000, maybe like 2,000 you may get some tax benefit. If so, then whatever the remaining the 4,000, you won't get the tax advantage, right? So the option is you can just leave it in traditional IRA, or there is another option, you can open a Roth IRA. Then it's called backdoor conversion. So you can just move that money from your traditional IRA to your Roth IRA. So that way, because anyway you didn't get any tax benefit. Let's say to some reason all the $6,000 you didn't get any tax advantage. So technically it's becoming after tax. So you can just roll over, move that money to your Roth IRA without any tax liability at the time. So then after that, you are completely tax-free for that Roth IRA.
Okay, thank you. So the next question is how to choose between Roth 401k versus traditional 401k?
Roth 401k and I'm sorry, could you please repeat that?
And just the traditional 401k.
Oh, okay. You mean the regular employer?
Just the employer 401k.
Oh, employer. Okay. So the question is the priority between the 401k and the Roth. So as I said, if you are paying too much taxes now, okay, your tax rate is very high. You are making huge income, and after retirement, obviously you are not going to work. So then definitely your tax rate is going to be very low based on your income. Then I would recommend to go with the 401k first, maximize it, then you can go for the Roth. But let's say currently you are not paying that much taxes at all, but in the future, after retirement, you are expecting a lot of income, your tax rate is going higher, then I would recommend prioritize first to the Roth, then go for your 401k. Okay.
Okay, we can have one more question and then we'll move on to the next segment. So would indexed annuities be a suitable product to invest in along with the 401k? Would indexed annuities?
Okay. Again, I think typically based on my understanding, within the 401k, due to the regulation, I don't think they allow the indexed annuity product within the 401k unless you take the money out of 401k, then only you can invest in indexed annuity. But based on my research, just like the whole life product, the indexed annuity, based on my research, I wouldn't recommend that because the reason is these indexed annuity, because the interest rates are very low, you are not going to get that much return. And again, when it comes to indexed annuity, I think I heard they are selling the indexed annuity. It's tied to the index. Kind of the same concept like the IUL insurance. So I see the lack of, again, transparency and a lot of commissions involved, and I don't think it's going to meet your retirement needs. I think you'll probably lose a lot of money on these fees and the hidden costs, and plus because the rates are very low, and I don't think it's going to help you to meet your objectives. So I wouldn't recommend that. Maybe in the future, let's say if the interest rates gone up maybe like 5%, 6%, and let's say you're retired and you're scared, you do not invest in the market, then you can at that time, even I would recommend buy plain vanilla index, just a fixed annuity, not index annuity. Buy plain vanilla fixed annuity because the interest rates are very high, so you can lock in with that interest, maybe 6%, 7%, which is actually similar to your market index returns, right? So I would recommend only that strategy. Maybe when the rates are very high, and maybe after your retirement, if you want like a stable income, just like a social security, then maybe buy the fixed plain vanilla annuity, but definitely not index annuity or any complex products.
Okay.
So another recommendation is, one important thing. If you decide to buy these kind of products, I would strongly recommend consult with a fiduciary advisor, like an independent advisor, to get the opinion. Okay, so that way they will analyze your individual family situation, financial situation, and see whether it's suitable for you. Get their input before get into this type of products. Okay. I'm sorry, Aaron, please go ahead.
Okay, so the question is also, what is a fiduciary?
Okay, that's a great question. Okay, the fiduciary is like me. Okay, so what I do is right now I don't work for anyone. No connection with any insurance company or any banks. I don't get any commissions, absolutely zero. Okay. So the way I work is I only work for the clients like you, and you pay a fixed fee. Okay. That's it. So I only work for you. So based on your situation, I recommend what best for you. Okay. Not for anyone else. So that's what the fiduciary. So the fiduciary means I recommend whatever is best for you. I put you as a top, okay, before anyone else. So that's what the fiduciary means. So that way you will get the best advice. So it doesn't have to be me, but you can choose any fiduciary advisor, okay. So that's why the power of fiduciary means.
Okay. The last question we have is, can I contribute to 401k and Roth IRA in the same year?
Yes, you can do both. Yes, but as I said, you may get into that income limit issue. Remember, I was sharing that slide, because sometimes you may not do direct Roth contribution. Let's say if your income is more than 203K. Okay, then if you're married filing taxes, then you may not be able to contribute to the Roth. But there is a workaround, as I said. What you have to do is, even though you may not get a tax benefit, contribute $6,000 traditional IRA, then you can do a backdoor conversion because it is a legal, IRS allows that, then you convert that into Roth.
Okay, thank you. I think that's it. We can move on to the next section.
Okay, thank you. Okay, so we are going to move on to the next topic. It's about the college saving. So before we talk about the college saving, I'm going to kind of give some background, whatever I collected so far. So unfortunately, the college expenses are very, very high in United States. So as of now, the in-state 4-year college is like $100,000, and if you go for out of state, it's a $200,000, and Ivy college is even higher, like $300,000. And just for a simple math, the value of this money, whatever we are going to spend for your kids, $100,000 investment, let's say if you invest in an index fund, by the time your kids reach retirement age, it will be worth $2 million. So you can see the value of money, how much this college unfortunately costs. Okay? Then I have just example, this is from the state of Virginia, Virginia Tech College. So this is the average cost. If you qualify for in-state, you can see this breakout. It costs about $30,000 per year. Okay, and the college inflation is increasing 4% every year. So with that, my prediction is in the next 5 years, the same college cost, the tuition cost is going to probably cost around $120 for in-state, maybe $240 for out-of-state by year 2025. And even in 10 years, in 2030, you can see it will be in-state going to cost $150,000. Out-of-state itself could be like $300,000. And even I did some kind of a return on investment analysis for this college investment, just for analytical purpose. So you can see for our kids to break even after you graduate and get a job. So he has to get a job, let's say, at a minimum with a salary of $50,000 from after his graduation. Then he has to work, let's say, maybe 40 plus years to break even that money, like because that money worth like 1.2 million. And if you study for out-of-state college with a $200,000 expense, then he has to get a job like a $75,000 job. Okay, then assuming he saves 50% in his saving, then it will worth like $2.5 million. So you can see even the break even itself it's kind of very high. Then just few tips for the high school students. So before selecting your college, I would recommend first analyze what kind of career you are going to do. Then check this college whether they offer those courses for your career. Then talk to the past students and get the teacher performance, how the faculty and the labs and the after-hours supports in the college. And you can check the ratemyprofessors.com to kind of see the colleges, the college teachers rating. And definitely check the college alumni network. Because unfortunately, that's how you're going to get your internship and job opportunity. That's very important. But just having the sake of getting the degree, it's not going to help you in the long run. And also analyze your cost for that college and see whether it's worth and see whether it's affordable for you and your parents. So do all those research before you're deciding the college. Okay. Then for the internship opportunity within the college, if you're deciding business or finance, you can talk to every college has an endowment office and run by the investment manager. You can easily get an internship over there. Or if you're in technology, you can attend a lot of startup events, entrepreneur events. You can easily get an internship opportunity. And also you can check a lot of government organizations like NIH, NASC, non-profit organization for internship opportunities. Then, okay, let's talk about the financial planning. So we talked about so far, it's a huge investment when it comes to college. So I would recommend try to meet this challenge through different ways. So the first thing is look for scholarship. I'm not talking about the college scholarship. Look for even outside of the college scholarship. So I have a few websites available listed out here, whether it's a college board or scholarship.com. So go to this website, try to find some scholarship that you have a higher probability to win. So I would recommend even when your kids are in 10th grade, 11th grade, ask them to start research, and you can easily get $20,000-$30,000 from this scholarship, because there are billions and billions of dollars of scholarship every year, whether from big companies or from these non-profit foundations. So I strongly recommend that. So that's option one. The second option is every state offers 529 plans, whether it's a prepaid or Invest 529. So I'll talk about that in detail in the later slides. So I would recommend that's one strategy. Then the third strategy is apply for the FAFSA, Federal Student Financial Aid, because the U.S. Department of Education, they provide a need-based aid, which is a grant that's purely based on your income. Then a merit-based aid that's based on your kids' academic performance. Then the third is your loans, subsidized loans or unsub loans or plus loans. So I would recommend try these three different strategies to try to split the financial burden. Then in addition, you can reduce the cost. You know, your kids select these AP credits so that when they go to the college, you'll get the college credits. So that will reduce your tuition cost. Besides the 529, there is another plan called Coverdell USA. So you can contribute $2,000 per kid per year. So that's another option. And after they get into college, you can also claim this tax credit, $2,500 per year. Then the one option I wouldn't recommend is don't withdraw your retirement savings to fund your kids' education. Okay, so I wouldn't recommend that option at all. Then I've seen there are some kids, what they do is to save money, even though the first year they may get in as out of state, but every college they have some rules. Maybe after 12 months you can work on it, convert that in the out of state in state. You can save tons and tons of money. So I would recommend try that strategy. Then the another one, educate your kids to manage the budget. Okay, once they get into college, they have to manage the budget, the expenses and all, right? So please educate them, even ask them to engage them to do it now when they are in home, because unless they learn how to do it, definitely they are not going to do it. Then the another thing is for parents, at least when the kids are in college, try to manage your expenses too. Maybe your expenses in the car, home remodeling, vacation, you can kind of plan it so that manage those expenses when your kids are in college. Then, so let's talk about the 529. So as I said, every state offers these plans. The advantage with that is you will get most of the state. I think I've listed here like Maryland offers $5,000 per kid per year. You'll get a state income tax deduction. Even Ohio offers $4,000. So by saving these in this 529, you will get a state tax deduction, and also you will get federal tax and state tax exemption on the earnings. So after you invest, once you decide to withdraw for your kids' college expenses, at that time you don't have to pay any taxes on it. Okay? But they offer two type of plans. Some states like a prepaid and invest 529. So the prepaid, I would recommend only, let's say if your kid decides to go with the state you are living. So let's say if you're in Ohio State and if your kid is going to only go in the state in Ohio, then you can go for the prepaid. So the advantage is you lock in the rate now. So you don't have to pay any additional cost even after 5 years or 10 years when your kid ready to go to college. But the drawback is, let's say your kid doesn't want to that to the particular state. Let's say you want to go to the other state, then the prepaid may not be a good option. Then I would recommend go with your invest 529 so that you can start saving maybe 5,000, 10,000 every year. When your kids are even in elementary school or middle school, start saving now so that when your kids get into college, you can withdraw that money and use it for your kids' education purpose. Okay. Then, as I said, there is another option also. You can use the Coverdell. So there is no state tax, but whatever the earnings you'll get, because just like 401k, IRA, you can invest this money under Coverdell too, just like 529. So the earnings are tax free. So you can also consider that. Then this is again kind of a general information. So when your kids are in high school or senior, you'll start applying the college application. So so you have to disclose all your AP credits, your SAT score, extracurricular activities, internship, all those things you'll be including. And the one thing I'm going to discuss in this application, the FAFSA application, they will ask you to disclose all your assets. So just for information, you don't have to include all the assets. So that's very important. So the assets you have to include in those application is your money, your cash, savings account, checking account. You don't have to include your retirement account, so the 401k, and also you don't have to disclose your primary home. But if you have an investment property, obviously you have to include. Because the reason I'm telling you is because if you somehow incorrectly include, then it could impact the ability of your kid and yourself to get some of the merit-based scholarship and also maybe some loans, okay, or maybe a need-based scholarship too. So that's why by incorrectly including, it could impact these kind of scholarship. But I actually asked a lot of parents, by having this 529, will it impact this scholarship? Actually, it will impact only the income-based scholarship, which is the grant. But if you look at the income-based, anyway, you're only eligible when your parents' income is less than $50,000. I think most of our, parents, I don't think will fall in that category. If you are making more than 50 grand, definitely you are not going to be eligible for the income base. So whether you having the 529 or not, it's not going to make much difference. And when it comes to merit base, definitely they are not going to consider the 529 at all, because that's totally outside. If the kids are eligible for merit, you will get the merit scholarship, no matter what. Okay. Okay, I think so. I'll stop for a few minutes. So that's all about the college savings. So we'll take a few questions, then we'll cover the last topic, the repatriation, transferring funds from India. Arun, so do you have any questions for the college savings or related college? We can discuss now.
So the first question is, how do we contribute money into the 529 plan from India if a grandparent is interested to provide fund for college?
Yeah, they should be able to do that. I think they can open this 529 plan. and then transfer the funds. Because technically, remember the 529, the kids are actually beneficiaries. They are not the owners. So the owners are either the parents or if the other grandparents they want to contribute to them. But I know if some state if they don't allow, then there is another option also available. Kind of they can also give it as a UTMA or a UTGA. I think I have it here. UGMA or UTMA, which is a Uniform Gifts for Minors Act. So that's also another option. So technically that money kind of is a gift from your grandparents. Then you can use that for kids' college education. So if you have any additional detail, maybe you can reach out to me offline. I can help you with that. But typically opening the 529 is a very easy process. Okay. You go to your state sponsored 529 plan website, then you can enroll, and then even you can automate your deduction. You can connect with your checking account, do like every month $50, $100. You can kind of schedule that transfer so that it will automatically go. Then you can, just like 401k, then you can decide which funds to invest so that you can grow that savings.
So the next question is there any all states 529 plan for the people who are relocating frequently? What are the things we need to consider when opening 529 account?
Okay, I would recommend if your state is offering state income tax deduction benefit, definitely go with the state plan. Because if you look at, remember when you file taxes, you might have noticed you can find a lot of different ways to reduce your federal tax. But there is no way to reduce the state income tax, if you have noticed in the last whatever the years we are in years. So that's why this 529 is one of the good vehicles to reduce your state income tax. So if your state offers that, I strongly recommend go for that. But if your state didn't offer any tax benefit, then I would recommend go with Vanguard 529, or even the best plan I have seen is the state of Ohio. Their plan was pretty good. Again, it was managed by Vanguard only. They have a lot of good options. You can allocate your funds. So I would recommend go with those kind of plans if your state didn't offer any tax benefit.
Okay, so the next question is, when your kids are due to go to college within 5 years, does it make sense to invest in 529 plans?
I would recommend yes. Remember, as I said, these college expenses are very high, right? So I would recommend trying to split that cost in like a 1/3. So 1/3 go with your scholarship option. Maybe 1/3 go with your 529 option, maybe 1/3 go with the FAFSA financial, either the loans or the other grants option. So even if it's a 5 years, I would still recommend do your 529. I think it's not a bad option.
So one more question is, can H1B guys allowed to take 529 plans?
Yes.
H1B.
Yes, they can, because they are legally they are living here, right? So they can.
So another question is, can 529 funds be used for education outside the country?
Unfortunately, no. So currently, it can only be used for education and only for within USA, any colleges in USA. But due to some reason, if you couldn't use, but you can always withdraw funds from these 529. But I think you have to pay probably like 10% penalty and whatever the capital gains taxes for the end. But you can still take your money there with you.
Okay, so the last question is, what is impact of FCPSA with 529 plan? What is the impact of FCPSA with 529 plan?
I'm sorry.
From Harish, yeah.
Is there any abbreviation? I think this is the first time I'm hearing. What is the FC?
FCPSA.
I'm sorry, but I think I have to research, and then maybe I can get back to you offline. Maybe you can reach out to me. So my email is mari@samathwa.us. Yeah, I never heard of this word before. I'm sorry.
Okay, I think that's it. The questions. You can move on to the next. Thank you.
Okay. Thank you. Okay, so I think let's talk about the last topic. Transferring funds, or what we call is a repatriation from India. I know a lot of folks, we kind of moved from India to US maybe 20-25 years back, and at that time, I think a lot of our guys invested heavily in Indian real estate, right? So I know it appreciated a lot, but now to support maybe the college expenses or other expenses, I think they would like to transfer maybe some funds from India to here. But unfortunately, there are a lot of process we have to follow. So you have to follow the rules from India and also the rules from US. So I'm going to quickly walk through that. So right now, up to $1 million per year, you can transfer. But before you do that, first you have to determine the taxability. So the taxability means whether, let's say, the property you are getting it from whether your parents, that means it's an inheritor. So that means obviously you don't have to pay taxes in India, right? But at the same time, let's say if you own the property, if you bought with your own money, now it's appreciated, let's say 50%, then you have to pay the capital gains taxes in India. Right now, I think it's typically around maybe like 20% or so. So you have to pay the taxes. Maybe to reduce the taxes, you could use some cost indexation method. But I would strongly recommend it's better to work with the CA, because to transfer the money, whatever the property you sold, you have to submit the outward remittance form and also APA form to your bank. And not only that, you have to submit the CA, Chartered Account Certified 15 CA and 15 CB form to the bank. Then only they'll allow you to move that money to your bank account in US. And plus, then once it comes here, then you have to handle the tax reporting with the IRS through the CPA here. Okay. And before that, you also have to do some more reporting here. Even if you're an H1 green card or citizen, doesn't matter. It's called FR or FATCA. So if you own more than $10,000 liquid assets in Indian banks, you have to report to IRS. So please consult with your CPA. If you fail to do that, and as you know, right now, all the banks, even in India, because of the treaty between US and India, now all the banks are sharing that information with IRS. Okay, so if you get caught in the audit and if they found, let's say, if you own more than $10,000, so you could face a penalty or other penalties too, and it's going to be maybe more than $10,000. And also, you have to file Form 8938 if you have any interest in financial assets in India. If you work more than, let's say, $50,000, if it's a single filing, or $100,000 if you are a married filing, then you have to file this form. Again, consult with your CPA. And if you fail to do that, and definitely it's going to incur huge penalties. Okay? And then to reduce the taxes, so I would recommend, so when after you transfer, the good thing is, let's say if you already paid the taxes, capital gains in India, let's say 20%, but in US, as you know, the capital gain taxes, if your income is less than, let's say, $500,000, actually the capital gain tax is 15%. So that means you don't have to pay any taxes here. In fact, sometimes you can also do a foreign financial tax credit too. So work with your CPA. You may get some tax benefit, or depending on the situation, you may have to pay some more here too. So when it comes to transferring the funds, whether you are selling land, properties, or even maybe you have invested in stock market in India, So all those things, you have to pay taxes in India and file all these forms. Then again, you have to work with the CPA here also report those income and pay the taxes accordingly. Okay. So this is at the high level. Like I said, if you need any help, reach out to me. And I know some few CAs in India and outside here, and provide more counseling in this topic. Arun, do you have any questions?
Yes. What all types of investments come under financial assets for reporting purposes? Like houses, agriculture, what all types of investments come under?
I think the short answer is pretty much everything. Everything is included when it comes to here. And even Indian government, in India, there are different rules. Actually, I heard if it's agriculture property, I think you may not be able to actually transfer the funds here. So you have to wait maybe 3 years or 5 years. So what people typically do is they sell that agriculture property, then they invest in some savings bond in India so that they get some tax exemption. Then after 3 years or 5 years, then only you can transfer here. I think that there are some rules and regulations, but pretty much everything we have to consider when it comes to assets.
Okay, another question is, if anyone has a home loan in India, can they include that home loan to USA, as a deduction in taxes?
No, I don't think so. But I'll please check with your CPA. I don't think you'll be able to do that.
So another question is, how does inheritance from India taxed in US?
So actually, the good thing is when it comes to inheritance, so you won't be paying any taxes in India. Also here, but I think you have to do the paperwork. There are the 15 CACB, there are the special paperwork you have to do. So that will declare it is an inheritance property. So that way you won't be paying any taxes either in India or in USA.
So are there any restrictions to transferring funds to India if you plan to retire in India? Like from here to India?
Oh, here to India? No. There is no restriction for moving the retirement funds from here to there.
So I think that's all the questions we have.
Okay. Good. So it looks like we kind of overrun by 13 minutes. But if you guys want, I know few ancillary topics I can quickly cover. So one is the mortgage. I know most of you guys probably have mortgages or own homes. So I would strongly recommend to consider refinancing, because right now the interest rates are very, very low. As you can see, the 30-year rates are 2.75 to 3.25. Even I heard this week even come down even lower. The 15-year, even I have seen even yesterday, some folks got even for 2%. If you have a good credit score, so 2% interest rate is a very, very good deal. So I strongly recommend. So if you want property, try to refinance, and if you need any help, you can reach out to me. Because I can quickly show you the mortgage refinance analysis. So let's say if you have loan maybe $300,000 loan for 30 years, you can see most of the money is going towards your interest. See, almost over 30 years, you are going to pay $280,000 to your bank as an interest, right? But if you refinance the same loan for a 15-year for, let's say, even 2.75, so look at your interest cost is $79,000. So you are going to save huge amount, let's say, as you can see, $200,000, right, over the 30-year period. So I think I strongly advise try to take an advantage, because I think it's a great opportunity for the people who are here. I think because of the COVID and other thing, the rates have gone down like drastically. Even a lot of people are even refinancing without closing their store. So please take that advantage. Then the next topic I will quickly cover is the life insurance. I think somebody asked a question I covered. As I said, my recommendation is go with the term life insurance, because the premium is low. You can take maybe cover 25 or 30 year term life, and if you need help, you can reach out to me. There are good websites are available, Term for Sale, Select.com. Get the quotes from good companies like AIG, Prudential, Specific. Then compare their quotes. I think, as I talked before, decide the coverage amount, the term, then buy the right insurance. And the whole life, as I said, always talk to some fiduciary advisor to see whether it's suitable for you. It provides some cash value, some tax advantage. You can take some loan option with the whole life, but the premium will be very high. And to provide a lot of products like IUL, 7702, VUL. So my advice is, please consult with the fiduciary advisor, then choose the right one. Then finally, the estate planning. We didn't talk about that. Particularly the people, since we are living here, unfortunately the estate planning rules are different here. So I would strongly advise at least have a basic will, power of attorney, healthcare directive. So you can do either hire an attorney to all those things. I know they charge maybe $600 per person. Or there is another option is there is online tools are available. Even there is a do your own will. It's a free software, or Quick and Will Maker. It costs less than $100. LegalZoom. So you can using this software you can do. But the thing is, you have to decide guardian. So if you have minor kids, you have to decide the guardian and the executor. So it's very important. If you don't have a bill here, actually, then you have to go through the court, because the court will appoint the guardian. They could assign anyone, right? So it's a very lengthy legal process. Unfortunately, that's the law in US in every state. So I strongly recommend at least have a basic will, the power of attorney, the healthcare directives. And if you need any consulting advice, please reach out to me. And also, if you need any trust, then I would definitely recommend hire an attorney to do this living trust, because the trust is a little powerful than the will, because you don't have to go through the court process, and it protects your assets from any litigations, and you can customize this trust in any way you want. So typically people go for trust. Let's say the kids are not good at handling their finances, so to protect assets, so they put everything in the asset. Then they say only the distribution will go to the kids, so the kids cannot sell the assets. And if you're working in high risky professions, or doctors or lawyers or other high risk area, they typically put assets into the trust so that it's protected. Okay. So that's for the assets. Then quickly, the post-retirement. So after you retire, the standard rule is don't withdraw more than 4%. Then you'll run out of money pretty quickly. And also to learn about how the Social Security works, because you may get some distribution from the Social Security. And you can activate it when you're at age 62, but you'll get the reduced payout. But if you wait until 66, at least your payout will be more. Because currently, as of now, people are activating at age 62, they are getting $1,300 per month. But if they wait until 66, they get around $2,300 per month. Okay, so just understand that. And also, when you actually activate Social Security, you will also get eligible for Medicare. So that's for your healthcare expenses. That currently covers about 80% of the medical expenses. Then the other 20% you can buy probably like a supplemental coverage. Okay? And in order to get eligible for this Social Security and Medicare, you have to meet the 40 credit. Typically, if you work for 10 years, and you will get eligible for this Social Security and Medicare. Then there is a long-term care. I know that's pretty expensive. So if you expect your health is not going to be that great after retirement, then you can consider this long-term care. And I know we already talked about annuity before, and I think that's it. Yeah. So my final word again is be healthy, reduce your work-life stress, start saving sooner, take a long-term view on your investments. So I know I covered a few more topics, but if you have any additional question, I can wait for a few minutes if we can discuss. So, did anyone pose any additional questions?
Yes. Yeah, the first question is, if I sell my inherited property in India, can I bring the money here?
Yes. But as I said, you have to follow the paperwork. So work with the CA in India and CPA here, do it properly. You can. Yes.
So the question on retirement is how to estimate and manage for medical expenses during retirement. People say some major hospitalizations could even wipe off retirement.
Yes, that is correct. Yeah, I would recommend, it's called kind of a long-term coverage. So anywhere from 300 to 500K, because if you look at the long-term care, as you can say in America, this is what the cost right now. So if you are asking for some home health aid, it's a $71 per hour, it's $120K per year. And if you want to go adult daycare center, it's again $80,000 per year. And if you want to go for assisted living facility, that's $140,000. So I think I would typically average people are in this long-term care with 3 to 5 years. So do the math. So I would recommend, so part of the planning, try to cover anywhere from maybe like 300 to 500,000, half a million. Include that as part of your retirement savings. So that way you will get protected.
So can if you are on green card, will you be able to get the SSN when you retire?
Yes. Yeah, you will be able to get it. Yeah, there are some rules. I think you have to be in US for some few months or some residency thing. You have to do that. Then you will be able to collect the checks from the Social Security.
So one more question is 15 years or 30-year loan good for the first-time home buyer, given the rates are very less? Which one do you recommend?
Yeah, I think I would recommend the first thing is you have to see your ability to pay, right? Because you don't want to get in foreclosed. You get into 15 years, even though the interest rates are low, but if the loan amount is higher, your monthly payment is going to be very high, right? So make sure that the first thing is see if your ability to pay. Let's say currently if both husband and wife are working, you can easily cover the mortgage monthly payment. But what if, let's say, due to some reason, one person lost a job, even temporarily for 6 months or 1 year, can you still able to cover your monthly payment, right? So do that math before decide whether the 15-year or 30-year. So let me say, if you have the ability to pay, then I would recommend, I think the 15-year option is pretty good because the rates are very low. Obviously, you are going to save lots and lots of your interest costs. Okay.
So one more question on the home mortgage. So on a tip, how much house should we buy as like, I mean, how much house should we buy? Like when we are working on, hold on, let me reframe the question.
Okay.
How much payment, is an affordable payment if you are earning $5,000 a month?
Yeah, I think the standard normally they'll say don't go beyond 30% of your let's say monthly if you're getting let's say take $10,000. Okay, so that means 30% is 3,000. So make sure that your monthly payment doesn't go beyond that. Because if you stretch more, then obviously you will, because other than the loan cost, so let me quickly show you what kind of expenses. So for any family, let's see how many expenses you have to support, right? Your health insurance, maybe traveling, utility bills, property tax, cell phone, car insurance, gas bill, or if you have a car loan, you have to pay credit card. So see that there are lots and lots of other expenses. Plus, obviously, you have to save some additional extra too, right? So that's what don't kind of go beyond what you are able to pay, and you may get into trouble. And unfortunately, then end up borrowing a lot and getting into debt. So that's not a wise options to do that. So yeah, definitely I would say maybe 30-35%. Don't go beyond that.
Okay, I think that's all questions. Thank you, Mari. Do you want to finish up?
Sure. Yeah. To recap, yeah. Thank you everyone for joining this webinar. I hope it was very useful. So I'm happy to help everyone. So in the future, if you need any help, please reach out to me. My email mari@samathura.us. So as I said, to recap, keep your emotions away. Take a long-term view. Start saving now, even if it's a small amount. Don't worry, and save it in the tax-deferred tools, as I said, the 401k, IRA, and start invest so that you can grow and have some plan to meet your long-term retirement objective. Okay. Again, with that, thank you everyone. Again, thank you Arun and Rajan, and also the Indian Association of Nebraska and Lincoln for providing this opportunity. I hope this webinar helps helpful for everyone. Thank you all.
Okay, thank you, Mari. Thank you very much.
Okay.
Thank you all for attending.
Bye.